Dear viewers, I recently came across an interesting post shared by Alpha Ideas. It cited a Wall Street Journal article that referred to a study by Trivariate which examined S&P Capital IQ analyst ratings over a 25-year period. The finding was striking. An investor who bought stocks with the highest proportion of buy ratings and shorted those with the lowest would have underperformed the broader market. Who says analysts aren't useful? They are, just perhaps not in the way most people think. The takeaway is not that analysts are incompetent, far from it. Most research reports are thorough, data rich, and professionally prepared. The problem is that following consensus, especially a strong consensus, has rarely been a winning investment strategy. There almost ought to be a disclaimer attached to every research report. Read carefully, but don't outsource your thinking. The irony could not be sharper. We are living in an age when information has never been more abundant and never been less valuable as a source of competitive advantage. With a few clicks and increasingly with the help of AI, anyone can access annual reports, conference call, transcripts, financial ratios, industry data, management commentary, and peer comparisons. AI can summarize it all into a polished investment note in a few minutes. This should have made investing easier. Instead, it has made it harder. Markets do not reward people for possessing the same information as everyone else. They reward those who interpret that information better, identify what others are overlooking, and have the conviction to act when prices diverge from intrinsic value. As information becomes commoditized, the information edge disappears. When everyone has access to same models, the same management commentary, and the same research reports, the analytical edge begins to shrink as well. What remains scarce is not information, it is independent judgment. You do not generate alpha by building ever more elaborate spreadsheets or refining your DCF model to second decimal place. Although at times DCF has often been misused as tool for validating bias and testing them. Alpha comes from buying a good business when it is mispriced and having the patience and conviction to hold it when prevailing opinion disagrees. If there is one segment where this side effect of information edge is most visible, it is Indian small caps. There was a time when small cap investing demanded real legwork. Information was scarce, annual reports were often the only reliable source of research, investor presentations were rare, management interactions were difficult to arrange, and conviction had to be earned through painstaking work, often including company visits and face-to-face meetings with the managements. Today, that landscape is entirely different. Every promising small cap company is tracked by multiple brokerages, discussed endlessly on social media and financial media, and dissected on YouTube, and summarized by AI within seconds. Information has become democratized. The unintended consequence is that a genuine mispricing has become much harder to find. That is one reason why many quality small cap businesses now trade at valuations that leave little room for error. Even as several macroeconomic uncertainties remain unresolved, the small cap to Sensex ratio currently stands at 0.73, which is dangerously close to previous peaks. Similar levels in 2008 were followed by sharp correction following the global financial crisis, while the peak in early 2018 was followed by a 40% to 60% decline in small cap index. History doesn't repeat with precision, but it often rhymes. That does not mean that small caps are uninvestable. It simply means that easy money has largely been made. Unless earnings surprise significantly on the upside or markets experience a broad correction, finding obvious bargains will remain difficult, particularly among popular names. If your conviction comes primarily from brokerage reports circulating on social media or from widely shared tips, it's good time to question it. So where does alpha come from now? Well, I believe it comes less from finding the next gem and more from doing the ordinary things exceptionally well. This involves maintaining valuation discipline, choosing quality over the hot tips, and being patient when nothing is worth buying. Most importantly, from focusing as much on allocations as stock selection. Stock selection gets all the attention. However, it is portfolio construction that quietly determines most of the outcome. Diversification protects us from our mistakes, but excessive diversification also dilutes our best ideas. This is hardly a new insight. Research shows that most of the meaningful reduction in portfolio risk comes from owning roughly 20 to 30 stocks. Beyond that, each additional holding contributes significantly less to risk reduction while nudging the portfolio closer to index like returns. Perhaps that is a real lesson for today's markets. Do you agree? Share your views in the comments section. Thank you for watching. Goodbye.